Thanks for joining us. So in the next two sessions, we're going to cover accounting terminology, account classifications. We're going to spend quite a bit of time on journal entries, the T accounts, because I think that will help you guys understand the balance sheet and income statement. I put some T accounts on an Excel spreadsheet to see if we can help you. We're going to look at customer service, communication, time management, and procedures and policies. So in the exam, Manon provided a little bit of breakdown about the exam content. So accounting basics. The payroll department really manages the largest portion of a company's income statement expense section. I'm going to say roughly payroll expense constitutes 60% of a business's expense on their income statement. So when we record stuff, most of us have really automated accounting packages, and we don't understand the flow of the transactions, but we have the actual transaction that takes place on a journal that goes through to the ledger and a financial statement. So when you record payroll or any other transactions, they impact multiple financial statements. They could impact the balance sheet. They could impact the income statement and your statement of cash flow. So journals record a chronological order of daily transactions of a business. So this is kind of going back to the green ledger sheet. Most of us don't understand that things have a journal. Like the payroll journal is just going to record your payroll expenses on a journal. The general ledger records all of the transactions posted to each journal. So if you're looking at your chart of accounts, if you popped open your QuickBooks or other accounting software and you see your chart of accounts, 1,000 or 100 being your assets, etc., you get down to your expense account. Usually they start with a 5. You will see each one of those general ledger accounts have its own journal. And if you're in QuickBooks, you can pop open that journal so you can get an understanding of what's in a journal. And it's just date of transactions that's in that journal, which is kind of a general ledger account. So accounting principles. So all businesses should follow the same accounting principles in essence, right? We all have financial statements. We all have a cash account. We may have a liability account. We have expense accounts so that we can group transactions so that we can compare one business to another business. If we didn't have financial accounting standards and GAAP, how could we compare one business to another? How could we compare, when we want to invest our retirement funds on the stock market, if those financial statements weren't audited and accounted for the same, we couldn't compare them. There would be no apples to apples. So that's why accounting is so critical. So continuity and concern concept. So continuing, every business, hopefully, is going to be a going concern. That means it's going to be, it's going to continue on. The period of time concept is a 12-month period. Most companies are either fiscal year or calendar year. Fiscal year can be any year that a company chooses. So a ski resort, for instance, may have their fiscal year ending in April versus December 31st. So it can be anything a company chooses. So the cost principle, think of that for just a second. The cost principle means assets are measured by cash spent, not what's in the mind of the beholder, right? So I happen to own a company that collects, I don't really own it, but if I did own a company that collects classic cars, right? And I find one, in a dump, and I can see that it's going to be one day worth $100,000, but I buy it for 100. So I'm going to record that transaction as purchasing an asset of $100, not of what my mind thinks it's going to be. So when we think about chart of accounts, so every business has a chart of accounts. And most accounting softwares back in the old day all had numbers. QuickBooks lets you have words, which can be, pros and cons. So typically all companies have, in the 1000 series, these are your assets. 2000 is liabilities, 3000 or 300 starts with a 3, tends to be equity, revenue is 4, expenses are 5, overhead are 8. And if you think of larger companies, most companies have this accounting structure. And in larger companies, they don't all have QuickBooks who have classes, so they use multiple digits to signify maybe departments, labor codes, etc., just by carrying out the digits. So again, accounting is a period of time covered by the information on the income statement. Typically, we look at monthly accounting and then it goes into quarterly, half year, and year. So if we look at a balance sheet, this is the typical structure of a balance sheet versus an income statement. So a balance sheet records your assets, liabilities, and stockholders' equity. So assets are listed on the top. It's most liquid. What can I convert into cash the quickest is how they're organized. So cash, obviously, first, is I can just write a check and convert it, then marketable securities, then accounts receivable. Inventory, it might take me 30, 60, 90 days to convert that inventory into cash. Prepaid expenses might be pretty quick. Maybe I've got a deposit for utilities, etc. So investments in other assets, if anybody's ever purchased something on the stock market, it takes a little bit longer to sell stocks and other types of assets. Say it was a car or something, it takes a lot longer. So again, it's further down on the balance sheet. Property, plant, and equipment, it might take years to sell a building, right? And then we get into our liabilities. And again, the most current liabilities are on the top, the longer term liabilities are on the bottom, depending on the size of your organization. If you've got notes payable, loans payable, the company will do journal entries to move a portion of the long-term liability. Maybe they've got a 30-year loan on a building or something, this long-term debt for $285,000. Maybe that's a 30-year loan, but in order to do some ratios and some other things with financial statements, you would want to convert, say, 25,000 for the current year into a current year. So move it so that you could do some ratios. So payroll will show up on a balance sheet. Your accrued vacation will show up because it's a liability, right? You owe somebody vacation time, you don't know when they're going to take it, but on the balance sheet, you have to create that liability because you can't wait until you've expensed it, or you can expense it and then create the liability. And if you record your payroll taxes, your quarterly taxes, it'll show up on the balance sheet also. Which account is listed as a current liability on the balance sheet? So again, if we look at current liabilities, they're in this section. So in part of our test questions, if everybody wants to jot in chat what they think it is, and then I will proceed. And I don't have my chat open to see. We're getting some consistent answers. Accrued taxes, you guys are right. So that portion of the payroll taxes that are going to be due within a year, you're going to have a credit on your balance sheet. So, yep, perfect. Great job, everybody. So the income statement is the other piece of the balance sheet, and it's for a period of time. So typically a month, quarter, or year, and it lets you know how your company is doing financially. You've got your revenue minus your expenses, and it'll let you know your net income per year. So non-operating expenses down here at the bottom are such things as interest expense, interest paid on loans, depending, and this company is a corporation because they have net income before tax provisions. So within a C corporation, the corporation itself owes income tax, unlike an S corporation where it's a flow-through entity on a K1 where the income flows through to the owner's income tax return and then they pay income tax personally. So this is the difference between a C corp and an S corp. So accounting classification. So be sure and understand our accounts. So assets minus liabilities equal the equity. So on a balance sheet, again, we looked at the assets, liabilities, and equity. So let's just pop back there real quick. So these are our assets, liabilities, our loans, our notes, our payroll tax liability equals our equity. So an income statement is revenue minus expenses equals the net income. So again, let's look over here. So we've got our revenue, it's our net sales, minus our expenses. So cost of goods sold. If this happens to be a manufacturer, they had to buy all those widgets, parts, and pieces in order to put them together to make their items to sell versus a service organization who probably doesn't have cost of goods sold. So you've got your revenue, you've got your expenses, and your net income. The statement of retained earnings is the net income minus income distributed plus contributed capital equals the equity. So retained earnings are the earnings that a company retains within the company. So they had their sales minus their expenses to get the net income. And then if they were a corporation, so you guys maybe own a mutual fund and you get a distribution. So that's income distributed, right? It goes out the door. It could be distributed to the owners of the corporation. Or if they needed capital, so maybe it was an IPO and so they sold stock or something to get capital. So money goes into the company. So those combined equals the equity of the company. So test tip, know what types of accounts show up on the financial statement. So we just covered that. So is everybody good on that? If you type a yes or no, if you needed some clarification, or if everybody's on mute, it looks like if you have a question, happy to help. No questions. We have way too many accountants. Oh my gosh, it's thunder. Okay. So again, account classification, I think we've covered it quite a bit. Assets are providing economic benefit or value to a company for a period of time. So cash, property, plant, and equipment, inventory. So there are things called tangible and intangible assets. So an intangible asset may be a patent. Expenses, cost of goods sold, rent expense, payroll tax expense, the employer portion. Liabilities are anything that the company owes, company debt that has to be paid sometime in the future. So payroll tax liability, it could be paid quarterly, or you've got FUTA and state unemployment, and it sits in that liability account until it's paid. Revenue is what the value that's received for goods or services. And equity represents the owner's investment in the company. And it could be, one owner, or in the case of a public traded company, many owners. So again, test tip, know which type of accounts show up on the financial statements. Again, assets are on pop quiz. What financial statement do assets show up on? Balance sheet or income statement? Woo! Balance. Look at you guys go. Expenses show up on balance sheet or income statement? Woo, look at that. Income statement. Liabilities, they show up on balance sheet or income? Balance. Correct, Mundo. Revenue, balance sheet or income statement? Revenue. Income, yep. Equity, balance sheet or income? Equity is the balance sheet. Look at you guys are going to do great on your CPP. You've got that covered. So journal entry. So you need to know this. And it's super, super confusing to most people. I can remember when I took my first accounting class at Montrose High School. I won't tell you the year. And my teacher was discussing T accounts and double entry accounting. And I thought he had fallen off the face of the earth, right? Because I was used to single entry, my checkbook, right? Couldn't get the concept of double entry accounting. So know that assets have a debit balance. So when you think of your checking account, and it often confuses people because when they go to their bank and they put their paycheck in, the bank teller goes, "We've credited your account." Yep, they have credited the liability account of the bank that owes you money. But it's a debit. The bank's assets went up, and the offset was a credit to a liability account to you. So liabilities have a normal credit balance. Equity has a credit balance. Income, credit, expense, debit. So if this is unclear to anybody, let me know. And we're going to do some T account stuff. So I think we'll beat it into the ground in just a second. And we are going to beat journal entries into the ground. So compound entries are like payroll entry. It's really a compound entry because it's impacting several accounts at once, right? It can impact cash, which is a balance sheet account. It can impact your income statement, which is your payroll expense, your payroll tax expense. It could have a liability account for your payroll tax payable. Maybe you have employee accounts receivable that you received. Maybe you have garnishments. So there are a lot of accounts within the financial statements that payroll impact. Okay. So I've got this trusty little sheet, and we're going to record some journal entries here. So on February 2021, the shoe store was a biweekly payroll. It had gross payroll minus deductions. So if somebody knows what the journal entry, what would I record for example number 1? And you guys can take yourself off mute. There's a little cheater. Okay. We have $6,000 of gross payroll. So we are going to debit our income statement for $6,000, right? And we have the following deductions. So it's a deduction. So we owe that money to somebody, right? So it's going to be a liability on my balance sheet. So I owe $6,000 payable because it hasn't cleared my cash account. I haven't written the checks yet. Some random numbers here. And I have taxes payable, right? So which is a credit on my balance sheet. So I know I have federal income tax, state income tax, Social Security, and Medicare, right? So I owe that to a governmental agency and health insurance. So I owe this as a liability until I credit my cash and debit this and get rid of it, right? So when I have this, when I create a payroll transaction, right, there's employer taxes that are also due. So that is a payroll tax expense because it's an expense of the company. So the company incurs $372 to match the Social Security, $87 to match Medicare, $36 for unemployment, and $324 for state unemployment, really high state unemployment. So that is a liability to pay those taxes, right? So it's $819. So the company's total payable to the government for taxes is the employee's share plus the employer's share, right? So I did this entry. Ooh, sorry. So I've got my 6,000 here as a debit. So equal and offsetting, right? For every credit, you have to have a debit. Otherwise, your journal entry doesn't match. And so we had a credit because I owe wages to my employees. I haven't written a check for them yet. When I write a check for them, right, cash goes out of my account. It's going to be a credit and I would debit this, right? That's how that would work once the cash goes. Depending how this company works, maybe, you know, they record this transaction because it's, you know, December 31st, that they're not going to cut the checks till sometime in January. So they want to record the liability. So, oops, I keep hitting my Excel spreadsheet. So they're going to write net checks. So the $3,841, because I had my payroll tax expense, I deducted all of my employees' taxes. So the amount that I owe to my employees in their net paycheck is going to be different, right? So as a checks, this is what's going to clear my account for each employee's paycheck. And so that wages payable. Whenever I move my arrow on my PowerPoint, it gets rid of my Excel spreadsheet. So the liability for the biweekly payroll would be recorded, and we did that. Employee Ernest was hired for the current payroll, and he missed processing his payroll check. So that would need to be recorded. So does everybody somewhat understand T accounts? We can continue to go through them, but I've got a lot of accountants on here. So if you understand T accounts, say yes. Yes, more and more. Manning's just going to be an accountant before we know it. Okay, so I won't belabor the T accounts. to death, a little more than I did. And I'm happy to answer any questions. And if you guys want to, instant message me or send me an email, I'm happy to help you guys figure out T accounts and journal entries. Because to me, everything typically always starts with cash. Because if I know what my cash is, if cash is going out of my account, it's a credit, right? That's a given. So then I would know that I have to debit something. And if we go back here to the normal account balances, right? Bring up my spreadsheet, my little T account thing. So when we think of assets, again, so here's my cash account. It's an asset on the balance sheet, right? It has a normal debit balance. So like I said, when you take your paycheck to the bank and they say we're crediting your account, they're crediting a liability and debiting it. So normally cash increases with a debit. So it would be here. So liability, so here's my liability, right? I've got wages payable. It has a normal credit balance. So I'm just going to highlight these.
So
two parts. Go ahead.
Is any time a line item is called has payable, is that an indication that it's a liability?
Yep, that's the key word. Keyword, absolutely. And it shows up on your balance sheet. So perfect. Yep. So my liabilities, payable, normal credit balance, right? Normal credit, normal credit, normal credit, normal credit. So equity, which I don't have on here, which is part of the balance sheet. Credit balance too, and it's a balance sheet and it's equity. Income and revenue, so we just have expense stuff here. And notice that my expenses are debits, right? Revenue. So when I sell something like services and somebody gives me money, I need to get rid of some of these. Somebody gives me $100 for looking at their tax return. We know I'm going to deposit $100 into my account. Its normal balance is a debit and it's going to increase, but I've got to have an equal and offsetting credit, right? I have to have something equal to it. I could have a compound entry and I could put multiple credits. But I looked at somebody's tax return, they gave me a $100 bill, I deposited in my account, my revenue went up. So I paid my light bill, so my cash account decreased. My cash account decreased because I wrote a check, cash went out of my account, and that was a credit, right? So I've got to have an equal and offsetting debit. I paid my utility bill. My expenses, as we can see, my expenses have a normal debit balance and they increased. So key accounts, amazing things. Okay. People who are accrual accounting, you know who you are, and At the end of a pay period, at the end of the month, at the end of the year, if you have a couple of days left in the month where your employees, I'm just gonna look at the calendar, this month is August. So for a good example, say maybe you're a bi-weekly payroll and your pay period ended on the 23rd of August and you pay on the 27th. You have the work days, the 24th through the 31st, that you need to accrue and book an entry into your financial statements so that the matching principle. So that's a good word for you, matching principle, that your revenue and or your expense, your wage expense matches the period in which it occurred. So you would do a journal entry and, based on, you've got 10 employees that make 25 bucks an hour and your state unemployment rate, et cetera, put it on on a spreadsheet and you go, oh, I've got $10,000 of wage expense that I need to record in my financial statements as an expense and a liability. I'm not going to pay it until September, but to have the matching principle of revenue, what I sold, my employees worked and generated stuff that I could sell and make revenue, and I have to match that revenue with an expense. They worked, they clocked in, they clocked out. So that's accrual accounting. And then when you so you record it on the 31st of August to match the month that was in, and then on September 1st, you just reverse that entry because you're going to pay it. So if you have financial statements you have to present or a larger company, that's how accrual accounting works. So, oh, look at that matching principle. Great. Next slide. According to the matching principle, salaries, expenses must be recognized in the month in which they occur, not when they're actually paid. So we just talked about that. So I would increase debit. It's on the income statement. It's a normal debit, $25,000. Again, accrued salaries. Manon, if it had the word payable, you would know that it was a liability and it would show up on the balance sheet. And then the beginning of the next month, bam, you just reverse it because you're going to record your normal payroll entry. And if you left it, it would be an overstatement. Pop quiz. An employee earned $12,000 in commission during the fourth quarter. This amount will not be paid until the following quarter. The journal entry for this item is go. So just remember, expense has a normal debit balance. So even if you have to remember that. So salary expense could not be a credit. So here's our answer. Hey, Melissa Belden, you missed the T accounts. I know you're sad. So again, and we just covered accruals. So does anybody need me to bring out my handy dandy Excel sheet and go through this journal entry? And I tried to make these dates on this calendar work so I could show you guys a calendar and do some stuff, and they don't work. So I'm not seeing people need additional help with T accounts and the journal entry to record this. Great. So PTO and bonuses. Specifically, if you're a larger company, you have to record that liability for vacation and PTO. It can get really big if you look at a bank of companies PTO that they need to pay out, and so every month you have to record that liability. You can expense you know, PTO expense and create that liability PTO due to employees. And then when employees take it, you would credit that liability because you don't owe that to them anymore because they took it in the form of cash out of your company, right? So pop quiz, which of the following journal entries is posted as a debit? All right, look at you smarty pants. B, the journal entry is B, 5,000 deposited into the checking account, posted as an asset. Because remember, cash is on the balance sheet and has a normal debit balance. Right. Okay, the power of reconciliations. I think checking account reconciliations, and not only just checking account reconciliations, but the reconciliation of a company's balance sheet every month it's critical, right? Because it will help you recognize when you've got that liability for payroll taxes payable on the balance sheet. You can look in that ledger and say, I had $100 from this payroll, etc., and it's in date chronological order. So you know what's outstanding and it makes sense and it doesn't get out of hand. So specifically the cash account, I think cash is king. And if you as a business reconcile your cash account, we do our cash accounts once a day, depending on the volume. Many companies probably do them bare minimum once a month, right? So when you reconcile your cash account, pay specific attention to outstanding checks, right? What could be a consequence of having an outstanding paycheck? Maybe the employee didn't receive it, right? Maybe a check was generated to an employee that wasn't due. So be sure you know all of those checks, what they're for, why they're outstanding. If they're outstanding, company policy, maybe more than 30 days that you contact the employee, right? Because we all know of sheetments and that you have to report those to the state of Colorado and turn those funds over. But if you can fix it ahead of time and contact that employee before they move to Alaska and say, hey, cash that paycheck, or oops, I need to void that paycheck because it was never really due, right? And if you do it in the same quarter that you have before you do your 941 and your state unemployment, it's much easier to fix than having an outstanding check for 6 months and then you've got to amend quarterlies. Woo, big trouble. Melissa, do you like amending quarterlies for voided checks?
No, it's horrible.
No, don't do it. Reconcile your cash account.
Correct, please.
Please.
Sooner rather than later.
Right. So again, reconciling your balance sheet accounts, not just your cash account, but if you could look in your liability accounts, right? And make sure that what you have outstanding as payroll taxes payable is really what's due. So internal controls, whew, here's a big one, right? Reconciling your cash account and having segregation of duties. That is huge, huge for internal controls. Having two different people with their eyes on things. Fraud, don't like to talk about it, but it happens, right? Super easy to happen in an accounting department. You get a disgruntled employee who happens to be able to write checks, be a signer, and gets mad at the boss, and nobody looks at their work. Not a good scenario. Also, payroll. It's really easy to put fictitious people in the payroll system and have that check go to the wrong person. So always take a look at that. And when you're doing your 941, take a look at your tax payments that you did through EFTPS and make sure that you balance that 941, taxes owed equals taxes paid. It's much more complicated now with the ERC credits. And so, every month, reconcile your cash account. Every quarter, reconcile that liability account. Look at your 941. Look at those outstanding checks. Do you need to void stuff? You need to correct it before you do that 941. Because the last thing that you want to do is have paid an employee $2,000 or $3,000, realize it was never due. You've had this check outstanding in your cash account. And what do? You do is W2. Oh my gosh. And you send it to him and he calls you in February and say, hey, my W2 is overstated. Then you just have a ton of work, right? So again, reconcile bank accounts monthly, build security into the system, double checks, multiple eyes, guard against phantom employees, define procedures for undelivered checks, define procedures for voiding checks, use an audit trail. QuickBooks is really easy just to hit void. Segregate duties. Yep, absolutely. Okay. So audits, internal and external. Most companies, unless they're larger, maybe they get governmental funding. They don't necessarily, or they're not for profit, which they're getting governmental funding. They don't necessarily have an audit. Maybe they have a review for a bank to look at the financial statements, but that's still not an audit. Many larger companies have internal and external auditors, just so that an internal auditor's double checking the work of all the employees just to make sure they're following standards and procedures and that stuff is recorded correctly. So Sarbanes-Oxley. So I was going to bring up some stuff about like Enron, right? How many compliance issues did they face? Matching principle, revenue recognition, phantom companies, phantom accounts. At that point in time, they didn't have the whistleblowers as much as they do now. So be sure that your company has financial processes and procedures in place to do the bank reconciliation, to have somebody check on it, to have somebody look over it, just so that you don't get the company into financial trouble. So Sarbanes-Oxley came about after the Enron debacle, just because they needed more internal controls. The American citizens as a whole needed more transparency and assurance for companies that you and I are investing our retirement into on the stock market. So that was part of the Sarbanes-Oxley compliance. And I think they ask you a question about Sarbanes-Oxley. So pop quiz. A task assigned to the payroll department would include all of the following except good job. Yep, reconciling that payroll bank account. Yep. We don't want someone who's entering employees into the payroll system, hours, generating a payroll check to reconcile that bank account. Yeah, internal controls are huge. And sometimes it's really hard with a small company and you have to really get the owner involved sometimes to like open the mail. Okay. How about, we're halfway through the slides. We're at 35. We've got 70 slides. So tomorrow we've got another beautiful hour. I know Melissa wanted a CT account. Does anybody else want to say anything? I'm joking. Melissa doesn't need a CT account.
I'm just so sad I've missed them both times you've presented them now.
Look, I'll show you my spreadsheet.
I'm so excited.
Look at that.
Oh, it's beautiful.
I know. So I'm going to take it away. I'm going to hit. So I'm going to do a little pop quiz in the thing, in the chat box. So cash has a normal what balance? What financial statement does it show up on? Look at you guys. Equity. This is a trick question. Equity has a normal what balance? What financial statement does it show up on? Ooh, look at you. What does payroll tax payable? Where am I going to find it? Payable. Ooh. What type of balance does it have, credit or debit? Yay, look at you guys. Too many accountants in the group. It's not fair. Not fair. All right, kids. It looks like we have time for a snack break before we all have to go back to work. Thanks. And feel free to email me if you guys have any questions.
Thank you,
All right.
Angela.
Have a great day.